Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out the charts that really seem to be saying something right now, and I put them into three categories: positive, negative, and then those areas that we're just keeping an eye on. Now, there's going to be some charts that are positive, but I'm also going to bring out some negative things. Just like on the negative side, there are some positive things that we can look at. So it's not cut and dry that easily. And this is being prepared for Monday, July 28th, where we're asking the question, is the S&P 500 getting exhausted? Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, first we'll go through and look at the positive side of things. Now, this is positive, but maybe a little too positive as far as sentiment. I use a daily chart. It updates actually multiple times throughout the day, put out by CNN Money. It's called the Fear and Greed Index, and we're up at a high level. Now, when we get around this level, this is usually where we're seeing extreme exuberance, and then we become overbought, and usually the market has some kind of a pullback. Well, for pretty much all the month of July, we have been around this 75 level, even a little bit above it. The market is still exuberant, so that's positive, and it's positive until proven otherwise. When we get to really high readings like this is when we start to look at it and go, maybe the market's getting a little too pleased with itself right now. And so we need to entertain the idea of using this as a contrarian indicator. But we really don't see any evidence of that yet. While this is going up or it's going down, we tend to follow that. It's just when we get to extreme readings where we start to develop the opposite kind of attitude of what the chart is telling us. Okay, then we did have an up week. And this is the intraday chart going back to Monday. Every one of these bars or candles is 10 minutes. If it's green, it's up. If it's red, it's down. Saw a little bit of trailing off in Monday's session going into the close. We actually went down on Tuesday. That set the low for the week. And then we were able to come up off of that. That looked a little bit more constructive. Then Wednesday was one of the more positive days. And as far as the intraday pattern suggests, we kind of started off really choppy, but then we were able to break to the upside and actually close at the high for the day. Didn't see all that much on Thursday. We opened up, we held on to gains. There was a little bit of weakness here, but the buy the dippers are coming in like crazy, and day traders are really active right now. We did see a little bit of trailing off going into the close. Then on Friday, we had a flat to higher open, but we got above R1, we got above R2. This is when we set the all-time intraday high, and then we closed just about down at R2. That set the all-time closing high. That's positive since we had an up week. Now, we're positive here because both the red line and the blue line are going up. We're a little bit concerned because the red line is starting to come up and cross above the blue line. This is an intraday look at growth versus value. In a more positive environment, we want to see the blue line above the red line. Now, there can be periods of time when the red line's above the blue line and the market still does quite well. But if this continues to go up, especially if we see the red line going up and the blue line going down, that's going to cause us some more concern. But for right now, it's still taken as positive. This is an intraday chart of S&P growth to value, where if you remember way back to July 1st, that was the beginning of the month and the beginning of the quarter, we saw this really go down as a lot of the money managers were loading up on defensive stocks. It's like, okay, well, then we kind of worked that off. We were able to get ourselves back up here and actually go up. Then we saw another day where this took a real big dive down, where value was up, growth was down. And so then it's like, okay, we've just kind of maintained a sideways move, but we're still going up. Now, we did trail off as we went into the close. It would be more positive, setting an all-time high with the S&P and having this set an all-time high as well. A little bit of a negative divergence, just something that we're keeping an eye on for right now. Then here is the daily chart setting a new all-time high. We broke above this dashed line that was providing overhead resistance for a few days. Now, these next R levels and S levels that you see, those are for August. And that's one of the things I like about pivot points is they're on the chart before we even get there. So we can be watching these levels well ahead of time. We are in an uptrend with the blue line above the red line here, setting all-time highs. Now, we spent most of the days over the last week actually being above average with volume, except for Friday. That's a little bit of a negative divergence there, setting a new all-time high and on a decrease in volume. Then we are looking more positive with the VIX. We're below 20 and we continue to decline, both with the line chart. That's the closing value. And we're also going down with the bar chart as well. Small cap growth to value ratio holding up okay, going sideways recently, but still in a longer term uptrend here. We're seeing some improvement with the small caps, but we're just kind of getting up into the higher end of the range that we've been in going back to the first part of July. Mid cap growth to value also breaking out a little bit above these previous highs and out of this range. That's still positive. Seeing a little bit more improvement, getting close to a golden cross with the mid caps where the 50-period moving average crosses above the 200, but we're not quite there yet. Unless we see a big downward move, that's probably going to happen this week. It could also happen for the small caps as well. Then this is the one that I'd pay attention to. This is still looking pretty healthy. S&P growth to value, setting a new high, breaking out, looking pretty solid there. And not back to all-time highs, but still looking okay when we look at this growth to value ratio. These are two ETFs that we do a ratio back and forth to see which one is outperforming. Then we look at a number of different growth to value ratios, actually falling a little bit below the moving average when we compare the Qs to S&P. Discretionary, the S&P, also below the moving average. These are just some warning signs. We've seen a pretty good run up here, and now we're seeing it starting to trail off. Now, we could have a solid up day, and this could go back up. But for right now, we don't know about that. We just know what we see right now. And this is giving us a little bit of a concern here, a little bit of a concern with discretionary to the S&P. We're still looking okay when we compare large cap growth to value. So we're above the moving average, and the moving average is going up the large caps. We're above the moving average with both the mid caps and the small caps as well. And we're setting all-time highs with the large cap growth ETF. So this is positive, and we're above all the moving averages, and all the moving averages are going up. Then we look at discretionary to staples, improving here, not really breaking out and surpassing this previous high, but this ratio is still showing an upward trend after we generated a golden cross earlier in July. We're still, for the most part, going up, not at all-time highs here with the risk on to risk off ratio. When this is going up, that's more positive. And not at all-time highs here. When we look at high beta versus low beta, when this is going up, that's more positive also. And this going down is more positive. This is value to tech, and it's not setting a new low here, but it's still declining in the bigger picture. That's positive. Still looking okay with the 20-period moving average study here. I use a double and triple exponential moving average. The lines are still going up. Now, the only thing that's a little bit of a concern is that we're seeing the green line and the blue line pretty much on top of each other. That's not a huge deal, but when we're really moving up, we'll see the lines actually separate from each other. But this is still looking positive when you look at the bigger picture. The intermediate term trend also looking positive. We're still below the red line, but the red line's going up and the blue line's going up as well. We're above all the plotted moving averages, and all the moving averages are going up. So from a trending perspective, we are still quite positive. And if you remember back into May and into June, and we've been dealing with any kind of sideways to even slightly down action, all above the 20-period moving average. And so that's positive when a market can correct and adjust itself without giving up a lot of gains in the process. We'll see if that can continue as we finish out July and head into August and September. We are far away, though, from the 20-period moving average. The boom indicator measures price in relation to a specific moving average. So the 20, we're far away from that. We're also far away from the 50-period moving average. We're going up here with the 200-period moving average study, but we're not extreme. And this is another short to intermediate term trend study. We're still above the green line, the orange line, and the blue line with price, and all the lines are going up. That's positive there. We're positive with the CMB composite, but we've gone above this black line. That means that we're getting extreme positive. And we're looking positive here when we measure how far away the S&P is from the 200-day simple moving average. We're going to get a little bit more concerned if we keep going up and we start to go above this dashed line. That would be 10% above the 200-day moving average. Now, we can go higher than that, but similar times back in 2023, we went above that and then saw a correction. Then in 2024, we saw it twice. It didn't do much damage here earlier on, but later in 2024, we did see a pretty good correction once we got to a really high reading above the 200-day moving average. It went even higher than that in July of 2024, and then we saw about a 10% correction here. So I just have this dashed line here as kind of a gauge because there's no real set amount. Then we are positive with the Landry light, but this measures more time. How long have we been seeing these green histogram bars being added to the graph? When we get longer than 40, that's when we're a little long here. You notice when we were going down, we got a little bit near the 40 level, and that's when this started to switch and suggest we were in an uptrend. So nothing really negative about this chart other than we've been in an uptrend for a long time, according to this. And nothing new was really drawn in Friday's session with the point and figure chart, but this is still looking positive. We finally broke out above this range that we had been in, and the most recent readings are with the X's. That's when we go up. This does not take time into account, just price, and we're still working off of a triple top breakout that was generated back on June 6th. We're looking positive here. We're setting all-time highs with the S&P advanced decline line based on price and volume. And we're above zero and going up with the advanced decline oscillator. And we're coming down a little bit here. You would think with setting new highs with the S&P on Friday, there would be another breakout with the new highs here. Slight negative divergence, but still, we're seeing a lot more new highs than we are with new lows. So we're going up with the 5-day moving average chart and the 10-day moving average chart. Still looking good here. Accumulation distribution above an advancing moving average, and we started to turn back up with the boom indicator. This tries to measure the action between the indicator and the moving average. Now, you could make a case for a bit of a negative divergence where we were going up with the accumulation distribution. We've been going down with the boom indicator here. Okay, a little bit of a concern, but we're not seeing anything really confirmed by the actual action of the indicator itself, at least to this point. We're still above zero with the short and intermediate term advanced decline ratio. We're going back up with the vortex, with the green line going up and the red line going down. Now we're positive here in the short term with our trend. We're a little bit concerned about this green line. It's getting really close to 40, and it doesn't matter if it's the black line, that's the ADX itself. I put the moving average on here to give us some context. But then we follow the green line and the red line. And when either the black line or the green line or both go above 40, we're a little bit concerned at that point. It may mean in the short term that we're starting to get exhausted. And then we're seeing a similar thing here with the intermediate term chart. And this is the one that I focus on the most. We're still going up with the ADX here above the moving average, but we're getting kind of close to that 40 level. And then this is a weekly look at the ADX, where we're still seeing a weakening trend after we had been negative with the red line coming down and the green line going up. We're positive now because the green line is above the red line. If we drop down below 20, that would mean that we're not in a trending environment, but we're not there yet. We are positive with the S&P McClellan oscillator. We're above zero. So when that's above zero, we're going up with the summation index based on price, and we're also going up based on volume. And after declining after Thursday, we turned back up over to positive on Friday with the swirling trading oscillator. We're back to advancing based on price and volume there. The daily parabolic SAR chart is positive. We have the dots underneath. We're also positive with the parabolic SAR weekly chart. We're getting a mixed picture here, but you could make it either positive or negative depending on where you come out. But we're actually looking a little more negative with the slope oscillator. It's declining below its moving average, but still giving us an extreme positive reading. Now we have another short-term oscillator. That's why I use a lot of them. That's actually positive. It's above the green line, so it's extreme, but it's going up as the other short-term oscillator is going down. So we're seeing a bit of a contradiction here between the slope and the TSI. Where the intermediate term oscillators, they're pretty much flat. You could say the MACD's trying to improve. We're flat here with the PMO and the PPO. And then we have two long-term oscillators, the Trix and KST. They're pretty flat, but still extreme. We're just below the extreme reading here with the KST, and that's slightly a little more negative. So positive to mixed, you could even make a case that it's negative. Now, we are positive with the Bollinger Bands percent B indicator. There's a lot of ways that you can implement Bollinger Bands. We closed above the upper Bollinger Band on Friday. That doesn't happen very often, and that's what the percent B indicator measures. So we're looking rather extreme. So this will adjust, but it can involve either price coming down or the Bollinger Band going up, or a combination of the two. So it's positive, but probably a little extreme positive. Another thing that's a way to interpret Bollinger Bands is how close are the bands to each other, and we're seeing them getting kind of close again. Now, we saw this back in May and even into June where the bands were getting close together. Eventually, we saw a breakout to the upside. Is that what's going to happen here if these bands continue to get closer to each other? Or are we going to have a break to the downside? We don't know that yet. We can just look and see what is on the chart right here and then watch as it develops. We're getting extreme with the intermediate term and short-term RSI, but they haven't even started to roll over yet. And we're positive, but looking extreme with the bullish percent index for the S&P. We're also going back up with the NYSE bullish percent index. Not extreme with the NASDAQ 100 bullish percent index, but starting to go back up and looking positive there. And then the cumulative advanced decline line for the S&P based on price, setting a new high on Friday, also setting a new cumulative volume all-time high here as well. That's positive for the S&P. And when we look, this is longer term, we look at a 50-period moving average of the new highs minus the new lows for the S&P. We're above zero and going up. That is positive. That shows more internal strength. And we're still positive here with the weekly special K chart. We came right down to the red line, and now we're starting to bounce back up. A little bit of a concern is that the red line is declining, but as long as we stay above this, this still remains positive. And we're getting kind of far away when we look at the 150-period moving average. We use this like an oscillator, similar to how far away are we from the 200-period moving average. Now, we're not there with the 200-day moving average, but we are looking extreme with the 150. But it's still positive until proven otherwise. And then we're above 50 and ticking back up with those stocks in the S&P above their 20-period moving average. Now, you could make a case for a negative divergence here. We've been going up with the S&P. We're seeing this trailing behind here. It's actually making a lower high. A little bit of a concern, but it's still positive for right now. Also, you could kind of make a case with the 50-period moving average study as well, but it's positive since it's above 50 and going up. And not so much here. This is looking a little better with the 100-period moving average study. We've been going up with the S&P, and this set a higher high. So longer term, that's still positive. Even though it did come down, it's positive since it's still above 50. And we're actually ticking back up and going up with higher highs here with the 200-period moving average study. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. This is looking good as well. This is the weekly chart of the S&P, but we have this R1 resistance level, which is right around the 64, 68 level. We're going to be watching that. We're not quite there. We're at 63.88 or 89 right now. This could end up providing overhead resistance if we break to the upside. And if you want to go back, pause this and look at some of the other times when we hit these longer term pivot points. Sometimes they were spot on. Enough that we need to respect this and watch for this. Then this also, and I have two different versions of this chart, and I draw the lines on here, and I try to stick to technical analysis purity, rules, because I've seen some charts that people post in various places. And as I always say, if you draw enough lines on a chart, you can get it to say whatever you want it to say. And this one, I'm trying to connect this low back in 2010 and also, the high in 2010 and this other high here, and then extend it forward. we're getting kind of close. Now, I drew this different version of this chart, and we're actually kind of there right now. So be aware of this. I'm just eyeballing this and trying to draw this the best I can. So just know that we're kind of getting close. The other chart shows that we're already there. We're still looking positive here when we do stocks to bonds ratio, and this is setting new all-time highs. And the assumption of the market is that when we're going up and we're above the rainbow and the rainbow is going up, that means the market is thinking that there will be a soft landing, meaning that we're not going to go into a recession. As we were really barreling down here in March and into April, the market was saying, uh-oh, we're going into a recession. This is when the Liberation Day was announced and the market was just falling apart. Well, we've since recovered from that, and we're back to setting all-time highs with this ratio. This is that same thing, but it's putting a bond to stock ratio down here. When this continues to decline, that is more positive. That means bonds are underperforming and the S&P is outperforming. And we want to keep an eye on this. We were concerned later on as we were really screaming down here. This is similar, what we saw in March and April is similar to what was happening at the end of 2021. This hit a high here with this ratio and then really started to come down. We set the all-time high early in January of 2022, but this was still going down. And then we went into a bear market after that. And then it was concerning that maybe the same thing was starting to happen here. But since then, we've come back above the rainbow. We're not back to the all-time high with this ratio, but we're clearly looking positive here. With our different advanced decline lines across different indexes, NYSE common stock, S&P mid caps and small caps were above advancing moving averages with all of the indexes. That is positive there. And this is positive, but you could read a little bit negative into that. This is a 10-day average of the highs and lows for the S&P. If we're setting all-time highs here, you'd think we'd at least be above the green line. We're not. Now, it did go up in Friday's session, and it's still positive since it's above 50. But it would be even more healthy if this was actually going up and getting above the green line and staying above the green line. And showing some improvement here with the equal weight version, that's in red, with the weighted version of the S&P, they're matching up closer to each other. Now, there's two ways to look at this. You can look at it on the negative side and say, uh-oh, the big stocks aren't really taking a leadership role right now, because when they do, the S&P outperforms the equal weight S&P. Or you could say, well, this just means more stocks in the S&P are participating, and that's good for the overall market. So it depends on where you come out with that. And we're coming off of a recent golden cross here with the Dow, not really breaking out much. We're a little bit above this pivot point right here, but we're not back to an all-time high. And believe me, if we do set an all-time high with the Dow, all the financial media will go crazy because they think, if you ask somebody how the stock market is doing, they say, oh, it's up 1,000 points, it's down 1,000 points. To me, that's not the market. The Dow is only 30 stocks. That's why I prefer to look at the S&P 500. And we're looking pretty good here. This is actually looking stronger with the NASDAQ itself, and it's actually outperforming the NASDAQ 100. We got above this pivot point. We're setting new all-time highs here. We're in an uptrend. Now, if we continue to go up, we'll be watching this next pivot point up here that could provide overhead resistance. And we're looking a little better here, but the NASDAQ 100 is underperforming. This still looks healthy, and it's still pretty positive. We were dealing with this pivot point right here, but in Friday's session, we were able to close up above that. But when you look at the momentum for the NASDAQ 100 as measured by the PPO, we're actually drifting down, and it's looking more negative than positive. I could have put this on the negative side, but I just wanted to include it with the NASDAQ charts. Small caps still above their 200-day moving average, just chopping around right now. A ways to go with the S&P 600 before we generate a golden cross, but at least we're on the right side of the moving averages. A little bit closer when we look at the other small cap index, the Russell 2000, we're further above the 200-day moving average. And we're getting really close. Maybe in the next day or so, we might see a golden cross here with the mid caps. Even though they're not doing all that much, they're staying above these moving averages long enough to bring them up, and that could switch that over to longer term positive. And then we did see a golden cross recently with the micro caps. These are even smaller than the small caps. So that's looking pretty good, but we're not back to an all-time high yet. Wilshire 5000, a broad market measure, setting an all-time high and in an uptrend. Total US stock ETF, also broad market measure, setting an all-time high in an uptrend. The FANG index has been doing a lot of sideways. Now it's positive in the bigger picture, but we're not really seeing a break to the upside as the bigger stocks haven't been outperforming as much as the rest of the market. Financial sector looking good here, setting an all-time high with the financial sector and in an uptrend. Where we're concerned is when we do a ratio, the financial sector to the S&P, we're still below the 200-day moving average with this ratio. That's a little bit of a concern. We've been watching this for a while. It really hasn't meant much to this point. We're just keeping an eye on this, seeing if it improves or if it ends up showing some more weakness. And robotics and AI ETF. I don't usually show this, but we're actually finally seeing a bit of a breakout here. Not to an all-time high again, but we're above the rainbow and really starting to move up. And for the last number of years, the robotics and AI ETF has actually been underperforming the tech sector. This is positive since we really came up into the rainbow. Now, we could lose that, but if we go above the rainbow and stay above the rainbow and these lines start to turn up, that would mean that this particular ETF is outperforming the tech sector. And then we look at some other stock to bond ratios. The S&P 1500 to 1 to 3 year treasury bonds setting an all-time high. And you're going to see a pattern or a theme as I go through these next few charts. Broad market to 3 to 7 year bonds, all-time high here. Tech sector to 3 to 7 year bonds, all-time high. The Qs to 3 to 7 year bonds, all-time high. And then this is going down, which is more positive. Now it's getting a little choppy as of late, but still the staples to tech ratio is going down. If this was going up like it was in March and into April, that's when the market is getting more defensive. So we're just seeing some little things, plus seasonality wise, August and September can quite often be weaker. So we're not really trying to jump the gun. We're not trying to front run this, but we are trying to make note of, okay, there are some things to be concerned about that we just want to keep an eye on. And the S&P to utilities ratio, it's going up, but it's not really going up with a lot of conviction right now. And then here, staples to S&P continuing to go down. That's positive. That means staples are underperforming the S&P. This is longer term and for the broad market here, a 5-period moving average of the highs and lows above zero and going up. That shows broad market strength. The Dow Jones Semiconductor Index not at an all-time high yet. The last couple of days, and I've actually been bringing this up in the daily video, the semiconductors have been underperforming. Now, some good news came out that you'd think would have helped them, but we're not really screaming up to the upside right now. It's still positive. We just want to keep an eye on this and see if there's a little under the surface maneuvering going on. The SMH semiconductor also positive, but not coming back to the all-time highs here and still above the rainbow, even though it's pulling back a little bit with the other chart that we look at. And then we're still dealing with the NASDAQ 100 weekly chart. We're pretty much at this trend line. Again, I drew this. I'm trying to use the rules here from this low to this low and then just extending it forward. But just about the time we got close to this trend line, now the charts are looking fine, but this is when we started to slow down and see the bigger stocks not have as much of a leadership role as the rest of the stocks. Still looking good here. NASDAQ to Dow, that's growth to value, above the red line and going up. Semiconductors to Dow improving, kind of slowing down a little bit as semiconductors have been underperforming, but we're still, for the most part, headed up back to this blue line. And the Qs to small caps, still looking really solid here. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then we have the negative side, and there aren't a lot, but these are just some things we want to make aware of here. This is smart money indicator number 2. Now, if you remember on the positive side, smart money indicator number 1, accumulation distribution, it's positive. Although we did see that negative divergence with the boom indicator. Chicken money flow, smart money indicator number 2, it's going down. We set an all-time high here, and this is going down. That's strange. And we've gone down the last couple of days here, and enough to make the red line start to go down. Then we have smart money indicator number 3, which is also declining right now, setting highs with the S&P, setting lower highs here and lower lows. That's a bit of a negative divergence that we want to watch for here. And we're negative with the Copic curve. This is a momentum oscillator. Now, I showed you that whole list of momentum oscillators, short, intermediate, and long term. I put that on the positive side. You could have stuck it on the negative side. This one, though, another momentum oscillator that I don't have on that other chart, this is clearly negative, the Copic curve. And then this is a weekly chart of the mass index. We triggered a reversal signal when we came back down below this red dashed line. It's still going down. Now, the farther we get away from this, the less relevant it becomes, but we're still keeping an eye on this. And this is suggesting that we might see a reversal. We were going up, and that could point to a downward move. But other than a few cracks under the surface and a few things that we're a little bit concerned about right now, there's really no evidence of that happening at this point. And then this is the daily special K chart. If you remember back on the positive side, I showed you the weekly chart. It's above the red line. We're still below the red line here with the daily chart. Even though it's improving, it's going up. We have not seen a cross here. And then we're still on a full-on sell signal with the Zohorchak method. And that hasn't changed. This is very long-term and something that we need to keep in the back of our mind. And we're still below zero with the NYSE McClellan oscillator. Now, we were above zero with the S&P McClellan oscillator, but the broader market NYSE, that's still below zero. So we're just barely going down here based on price. We're actually still going up a little bit here based on volume. Not a big deal, but when the McClellan oscillator is below zero, we treat that as negative. And we're still negative even though we're coming back up into the rainbow when we look at another ratio of home construction to 3 to 7 year bonds. And this is what's concerning me right now, is that we've been going up for the most part with the semi to tech ratio. Now we've been coming down, even though we're setting all-time highs with the NASDAQ 100 and S&P. To see this ratio coming down when that's happening is a bit of a concern. Then some different things that I'm just keeping an eye on. We are seeing weekly jobless claims continuing to fall. That's positive. That's holding up the labor market, at least in the initial phase. But we're flatlining right now, but we're still getting a pretty high reading with the continuing claims. So folks it's like companies are less likely to lay off people, but those people that do get laid off, they're staying unemployed for longer. And we're still below the 2 million mark here. If we go above that, that's going to be more negative. And we're going to have the big employment report on Friday, and we'll see if that adjusts any of our outlook with things. And then the skew index. We were up in the red area. This is a variation of the VIX. Now we've dropped back down here. And that happened after Friday. And other research that I was doing showed that people were buying a lot of call options, hoping that the market would go up. Well, they must have got rid of them in Friday's session because now the skew index is coming back down. So they were anticipating that we were going to set a new all-time high, and we did, and they sold at that point. That's the interpretation that I'm using for this for right now. So we'll just see if that plays out. And then volume, we've been above average for many of the days this past week. But as we hit the summer months, not a real surprise, we've been below average for the most part with volume. So we're keeping an eye on that one. We're also watching the 4.5% level. We've been watching this for a long time now with the 10-year yield. We were starting to get kind of close to it. We were headed that way, but then interest rates ended up coming down in Friday's session. And we're looking at the relationship between different maturities of bonds to see, are they afraid of inflation really picking up? The first one here is cash to 3 to 7 year bonds. That's not showing any real problem with inflation. Now, we were going up, and when I did this video a week ago, this was a little bit concerning. But since then, we've kind of calmed down a little bit when we look at tips to 3 to 7 year bonds. When this is going up, that means folks are worried about inflation and interest rates going up as well. But that seems to be taming for now. The same thing here with tips to 7 to 10 year bonds. We were really starting to go up. Now we've fallen back a bit. So that seems to be under control. But I look at these charts every day. And then we want to keep an eye on the 10-year to 3-month yield curve. We're not inverted right now, but we're just barely positive with the yield curve. And we want to keep an eye on, this is more of a sentiment gauge for bonds. When this is going up, that means people are happier. There's less fear happening in the market, and that's more positive. And we want to keep an eye on oil. Currently, we're right now in the mid 60s. The dollar continues to be in a downtrend, which typically is more positive for stocks. And just to compare American to European markets, we have the German DAX still above its 50-day moving average. And we do a ratio of US stocks, the S&P versus German stocks, the DAX. And this has been bouncing up, where earlier in 2025, this ratio was really coming down. And we haven't bounced up far enough to say that US stocks have regained a leadership role, but we are seeing some improvement here. And then some different sectors. Now, the top sector is a weighted version of discretionary to staples. And the weighted version, that includes Tesla and it includes Amazon. Those are the biggest stocks in the discretionary sector. Showing some improvement here on this one. Where we get, I think, a little bit more insight is when we look at an equal weight version of discretionary to staples and do a ratio. This is kind of topping out after it had been showing some more improvement. And we look at tech, which is growth to utilities. And I know, as I mentioned in other videos, you could make a case that utilities are actually growth now because of all the need for AI and EVs and crypto mining and so forth, the need for electricity here. But it's typically been considered more defensive. And coming back up here after, but it was seeing more strength here with the tech to utilities ratio. We're actually declining now with the biotech to healthcare. That's growth versus value here. And hotels, which are discretionary to utilities, seeing a little bit of an improvement there. Also, some bellwethers. Semiconductors just kind of flatlining recently. You would think they would be participating in this upward move. They haven't been over the last few trading sessions. Home builders, they were doing better, but now starting to fall back a bit here. Just kind of drifting along range bound, but showing some improvement with the transports. Retail was doing better, but now starting to pull back. Regional banks, these are smaller banks. They had been doing better, but in a range, and now they're starting to break a bit to the downside, which is lining up with what we're seeing with the financial sector underperforming the S&P. So that's why we want to keep an eye on those things. And retail, it's actually starting to flatten out here after a long period of retail underperforming the S&P. But then when you look at it by itself, we're in an uptrend with retail. We're above both moving averages, and we're above 50 with the RSI. So it's positive by itself, showing some improvement here, but in the bigger picture, it's still underperforming the S&P. Then US versus international stocks, a little bit of an improvement here, but if US stocks were really starting to outperform and take leadership, we would see this ratio really going up. And it is going up, but not with a lot of conviction. And we're actually seeing a little bit of a trailing down with momentum stocks on a ratio basis with the SPY. Now, this means that the SPY is outperforming momentum stocks, which you could take as positive. But you could also switch this over and look more negative, saying that how the momentum stocks are losing momentum as the S&P has been setting new all-time highs. Emerging markets versus developed markets. Now, developed markets would be the US and Europe. Mainly that would be Europe in 2025 because US stocks have been underperforming. We're seeing a little bit of an improvement here. It was starting to break out, but now we've seen this pull back recently with this ratio. And then these are the pivot points for Monday's session. They're updated on the website. They're also updated on the YouTube community tab. So thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.